A financial market is a market in which people trade financial securities and derivatives at low transaction costs. The market that is most sensitive to inflation, which is the long end of the Treasury curve, gave up the entire early session rally. Even the front end gave back a big chunk of its post-report yield slide. In this video, we're going to discuss the bottom of the market in. The video is going to be amazing, so make sure you stick to the end. Before starting the video, make sure to smash the like button and subscribe to never miss out on any of our videos. But the stock market soared, and the dollar sank on the belief that the peaking out and rolling over in inflation will somehow push the US Federal Reserve to the sidelines and lead to a soft economic landing. So, when investors grapple with market volatility, one question often emerges. Will the market rebound now, or is it headed further downward? While there are no certainties in the market, history shows that specific indicators can help investors tell if the stock market will bottom out. The stock market bottom during a bear market is the lowest average price of securities fall. Over the past 5 years, we've seen a compound growth rate of 15.9%. This is one of the strongest 5-year periods in US financial history. We've had two very different political administrations, a politically divided country, a pandemic, trade wars with many countries, and growing inflation, not to mention supply chain bottlenecks, riots, and increasing crime. And the stock market keeps adding value. Whether your stocks are providing great returns or plunging to historic lows, it's challenging to beat the market over the long haul. Financial advisors can help individuals optimize their investments and meet their financial goals. Their expertise gives them insights in how to minimize losses during a bear market and find opportunities for gains. Investing is complex, and a field of professionals makes their living just by working in it. Meanwhile, Rich Ross, Evercore ISI Senior Managing Director, says we may be looking at a cyclical bull market. Look, I'm not saying today is day one of the next great secular bull market, but I'm telling you that we are probably in a cyclical bull market now, said Ross. The bear market that commenced back in February on an index level is over. The lows are in, and we should now be buying dips rather than selling rips, as has been the case for the last 6 months, he added. When you think about an S&P that peaked around 4,800, I think 4,600 is a realistic upside target. I think 15 and change on the NASDAQ 100, NDX, is a real upside target. Those are levels that are worth playing for, he added. After markets suffered their worst first half-year performance in decades, stocks have bounced on hopes the Fed may ease up on monetary tightening. The central bank typically does not end a tightening cycle until its policy rate is above inflation. Currently, inflation is 8.6% per the Consumer Price Index, and 5.2% per the Fed's Preferred Personal Consumption Expenditures gauge. At this pace, we would need to see genuine damage to the labor market before the Fed would change course. And as evidenced by June's job report, employers added 372,000 jobs, above estimates, and the unemployment rate held at 3.6%, near a 50-year low. The market remains robust. The drop in inflation is nothing for equities to cheer about since it's not being met with any shift in the Fed's tone. There is an added element here of demand destruction in this newly found disinflation that works against, not for, corporate profitability. Look at it this way. Every recession brings on lower inflation, and there's never been a recession without a bear market in equities. And more often than not, that means down 30% to 50% from the peak. While China and the US are at odds politically, the US remains China's top trading partner with 17.5% of China's trade in 2020. The US traded more with China than all of the European Union combined. A recent agreement between the US and China out of the COP26 summit regarding combating climate change may be the first step to further normalization of relations. With this as a background, we turn to fundamentals, which we hope will give us a sharper forecast for 2022. If you can make your peace with riskier stocks, then losses on some of your more aggressive positions might not bother you. However, If you have a low risk tolerance, investing in stocks with less risk and less reward might be a wiser choice. Bear markets happen to everyone, but what's vital is using an investment strategy that matches your preferences and doesn't cause you stress. Granted, supply chains may be clearing and energy prices are dropping, but this is partly the result of short-term fixes, such as added supply from strategic oil reserves, which could be offset quickly, especially if the $220 billion fiscal stimulus that China is mulling does not come into play to shore up the country's economy, potentially stimulating demand amid still limited supply. We believe it's too early to price in an imminent recession. More likely, we'll see stagflation, where growth slows but is nominally positive. Inflation stays higher for longer, and financial markets continue to face volatility. For more realistic clues about the pace of Fed policy, investors should watch second quarter earnings guidance and labor market data. Let us know your opinion in the comment section below. That was all for today. We hope you liked the video. Do not forget to subscribe to our YouTube channel. Stay safe, and we'll be back soon with another video.